Hi, I'm Byron Moore, and this is my partner, Mike Jones. It is beautiful July in the summer in Ruston, Louisiana. So naturally, what we want to talk to you about is icebergs.
That's correct.
That's right. So we as we visit with each of you on a regular basis, themes tend to come to us from your mouths as you ask kind of the same questions. Different people we kind of hear these themes develop. And one of the themes that we're hearing more and more is we're realizing that some of you are asking about things that we would call the tip of the iceberg. Great questions. We want to address some of those. But we also want to remind you that there are things beneath the surface. Mm-hmm. And as most icebergs are, much more lies beneath the surface than above. So let's talk about what's sort of visible above the surface, and then we'll get to the hidden stuff in just a minute. The first is what keeps coming up over and over again in our conversations with clients, and that is the topic of inflation. Inflation hit with a roar a couple of years ago, right in the middle of COVID, and then the government pushed out a great deal of money to sort of rescue the economy from the effects of COVID. Mm-hmm. That had a rather predictable, from this side, it seems obvious that it was a predictable result, which is inflation. But Mike, talk to us a little bit about how inflation showed up and kind of where are we right now in this inflation cycle?
You betcha. Take one step back, because the Federal Reserve has been given by Congress two mandates. One is to try to get our country in as full of an employment picture as we can, mm-hmm. And the other is to keep some level of inflation. 2% is the current target. Mm-hmm. Certainly deflation would be a scary thing, yep. But then from time to time, it does get away. Mm-hmm. And as you alluded, post-COVID, the realization that the Fed had put a lot of money in the system, but at a time when services couldn't be garnered, which means goods could be garnered. Yep. Mm-hmm. And so the price of goods just went up and up and up. Mm-hmm. And so we're going to show a chart that you can see, especially over the last 2 or 3 years, how inflation did go up for the first time in many, many years.
Probably 20 something years before it went up that much.
40 years, mm-hmm. say, since it was roaring. Mm-hmm. And so the Fed had to do something as a result of that. And of course, that was they had to raise interest rates. Yeah. And so inflation, because of that raising of the interest rates, inflation has been coming down. I think our last video, we talked about it. If you can look at the chart once again, you can see that it is coming down, not to the 2% level, but down precipitously where it was, and even below the 3% level. So great progress has been made on that front.
Yeah, just this week, the Fed Chairman Jay Powell came out and said, we're close. He's not making any promises or giving any timetables. He stringently resists that, but he says we're close. Mm-hmm. And what that practically means is the second thing that's some of the visible portion of the tip of the iceberg, which is this interest rate issue mm-hmm. that you just raised. So when interest rates were raised, of course, that raised mortgage rates, mm-hmm. and then rates just to get any kind of loan, car or just a personal loan down at your bank. And so those things have been causing a good bit of consternation, even as the Fed has used that tool to tamp down inflation. So the question out there that's on everyone's mind in the market is, when is the rate cut going to come? Right. And what's been sort of the scuttlebutt so far?
Well, the scuttlebutt was that those rates were going to come down after the first of the year.
Yeah. Hey, we're past the first of the year,
That's
Mike.
right. It did not happen. The economy thank goodness, it did keep going well. The higher rates has not choked off our economy, but they are now, we're starting to see signs of just a moderate slowdown of the growth. And as a result, that gives the Federal Reserve that wiggle room to start lowering rates some. I'm going to pretend that we're not going back to a time where rates are super, super low. So if they are moderately higher than they need to be now, they need to be moderately lower. And so we have an interest rate chart that shows what the Fed did, where Fed funds have now gone to between 5.25% and 5.5%. What's really interesting about this chart, if you'll focus your eye on where both the market is predicting rates will go and where the Fed, the people in the Fed who make those decisions, where they are predicting they will go. And what you will see is the next move in interest rates is down. That's been a while in coming, and so for our investors and for the people that we serve, it actually does play into decisions we make with your money. And the decisions that we have decided to make is to start going a little bit longer in term on the interest rate investments that we lock in on, and to look at investment grade corporate bonds, once again, a little bit longer, and U.S. government bonds a little bit longer. And we've got something to look at. It's a little busy. Don't need to spend a lot of time on it, but we'll throw it up in the video for someone to, if they wanted to pause and examine, because it shows if interest rates go down 1%, which things would make, possibly what type of returns, versus if interest rates went up 1%, what would happen. And it shows that prognostication of shorter, medium-term government bonds and corporate bonds being two of the best things to be invested in this cycle. So we thought we would share that with our clients to see that, yes, we are thinking about these things and we are making those moves. Many of those changes we're actually implementing this very week.
Great. So we felt the pain of inflation and the further pain of an increase in interest rates. A question that we get perennially every 4 years is, how is this very unique election cycle, how does it stand to impact markets? People usually have very strong opinions, one way or the other, about how the election cycle during a presidential year would affect markets. But Mike, you've taken a historical look back over, I think, something like 100 years at how presidential election cycles have affected markets. And I'm really interested to hear what you have to say. Well,
we have data now that goes back and can break down the market, especially very clean data on markets going back to 1927. So one research house that we pay so that they will do this heavy lifting of research and send it to us. And this came across my desk showing that election year cycles, that part of the 4-year cycle does tend to be one of the very best years for investing in the stock market.
Interesting.
What's even more interesting is this pattern of the market doing well through the summer, having kind of a lull in the fall, and then at the election time and through the end of the year having a good run. And so I think that people who start thinking like, what changes are you going to make? What are you going to do with my money because there's an election coming? I think it's good for our customers to know that, we want to hold what we have. This is actually historically a good time to be invested as opposed to a time to be thinking of moving money to the sidelines.
Got it.
So we're not moving money to the sidelines because the research shows us otherwise.
Okay, great. So that's election cycles. Now let's poke our head underneath the water and look at the size of this.
Let's review.
Okay.
Let's review. So, tip of the iceberg
Would be
what are the things, the topics of conversation we've been talking about?
Inflation,
Right.
and interest rates, and then the election cycle.
And the election cycle.
That's where the conversations are.
Yeah.
What nobody's talking about is where the iceberg is probably 10 times larger, and we would both say maybe 10 times more influential, and that is
corporate America.
the health
Yeah.
of corporate America, which is unfortunately really boring, but really exciting when you see the effect it has on all of us.
Yeah. Yeah. You don't turn on the evening news and get like, here are the 5 things that are going well today.
No,
you're going to get the headlines will be, here are the problems.
Yeah.
And so, the 2 slides that I pulled that I want to share, in relationship to this topic. Number 1 is a slide on the health of all of America economically, GDP, our gross domestic product. Because what you might not be aware of is there's a trend that started, 25 years ago. We got off of that trend big time during COVID. Okay. We have now made up that trend and more, so that if you look at this particular chart, you will see we're economically we're back on track where we have been the last 25 years. Amazing, the ingenuity and the management of the business of America is really going quite well. The second chart is one that shows where corporate earnings are right now, where corporate earnings look to go to, at least by the research analysts that follow these things over the next 2 or 3 years, along with kind of a history of profit margins. Okay. We talked about this particular topic last time. I'll bring it up again because over the next 2 or 3 years, we expect for corporate profits to stay strong and corporate earnings to grow,
Excellent.
And so I'm going to flip the script on you and ask you a market question.
Okay.
If corporate profits grow, what tends to happen to the stock market with respect to that?
Quite obviously, the market recognizes there's greater value there, and eventually you tend to have an increase in the price that the market demands for each one of those stocks. So the portfolio goes up in value if all things are, equal, which they never are. But that's the economic push is in that direction. So that's why we have, for so long, for our whole careers, been such big believers in participation in the American economy and the world economy, but especially the American. Not that we know what's about to happen around the next corner. None of us do. But there's this strong economic push, and history bears it out, that money in financial markets in the United States of America has done really well over the long term.
Yeah. So there's always a list of things to be scared of.
Exactly.
And we have much less control in this world, in this life, than sometimes we think we do.
Correct.
But on the whole, the future that I can see for someone investing in securities, stocks, bonds, cash, and the like, is still very promising at this point in time. And so we do encourage everyone, not to pay too much attention to the headline of the news, to look beneath the tip and go below. And I think that tells a very good story right now.
Agreed. So our message to you, as always, is as things change in your personal situation, please contact us and notify us, because we don't have a way to read your mind otherwise. We'll be reaching out to you with these videos as well as individual attempts to meet with you when that time is appropriate. But I guess our message is that we can't predict the future, but we really like the temperature of the water right now. And so we remain firmly optimistic.
Great.
And so great to come to you again this summer, and we will look forward to our next visit with you very soon. For Mike Jones, I'm Byron Moore with Argent Advisors.